Hi, everyone. Welcome to another episode of Amplified Wealth. On this week's episode, we have Jonah Gruda, a partner at a top 25 CPA firm, talking about tax planning for 2025 and beyond. He explains the TCJA, key provisions, and what potential changes could be coming down the pike as we approach the 2025 expiration date. Jonah also discusses why now is the perfect time to review your estate plan, especially for high net worth individuals, and offers insights on the future of tax rates. He shares actionable steps to take today and emphasizes the importance of collaboration between your wealth advisor, CPA, and estate planning attorney. Enjoy the episode.
So I Googled what Long Island's famous for, and I got beaches, bagels, and Billy Joel. Is Billy Joel from Long Island?
He is.
He is. I didn't know that.
He's actually from my wife's hometown.
Oh, okay.
Where's that?
I believe it's Massapequa, or maybe that's Seinfeld. Well, Seinfeld's also Massapequa, and I think the Baldwin brothers are from Long Island as well.
Okay. Very interesting.
The problem with Long Island is we used to live in Manhattan. When you go from Manhattan to Long Island, you break up with your friends and family. Because there's one way in, one way out, and there's no reason to ever go to Long Island if you live in Jersey or Manhattan.
Yeah. Does Long Island like that? Is that part of the Long Island charm, or is that something you guys are trying to find a solution for?
I think it's part of our charm.
Part of the charm. There you go.
Charm is what they're calling it these days?
Yeah, I think New Jersey just wants more bridges. We need more access. More access to New York.
That's right. Well, yeah, I don't like having it's one way in, one way out on Long Island. We're stuck.
Yeah, that's it. You're in or out. All right, you want to start this? Move forward here. So
let's cue the music.
Let's cue the music. All right, so today on our podcast, we have Jonah Gruda, a tax guru with over 2 decades of experience. He is a partner and the national market leader of private client services for Withum, a nationally recognized public accounting and advisory firm. Jonah acts as a strategic quarterback of sorts for high net worth individuals, executives, investment bankers, entrepreneurs, and even hedge fund managers. He works with his clients' outside professionals, including their attorneys, investment advisors, and insurance professionals, to help them navigate everything from tax planning to wealth preservation strategies. Jonah's not just a tax whiz that simply crunches away at numbers. He's been featured in major publications and the media, such as the New York Times and CNBC. He has also been previously named on Long Island Business News's 40 Under 40 list, as well as their ones to watch list. When he's not working with clients, you might find him supporting causes like the Jewish National Fund or the Crohn's and Colitis Foundation. Let's get ready to dive into some serious tax insights. Welcome, Jonah.
Thank you for having me. That was quite an impressive bio.
There you go. I stumbled a bit, but I thought I put a nice spin on it.
Hey, you're responsible for that impressive bio.
It was my marketing coordinator. I'm really honored to be part of this podcast. I've really enjoyed some of the past presentation you guys have done, so I'm really pleased to be part of this.
Awesome. Thanks for listening. You are. It wasn't in the bio, I don't think, but I want to dive into this a little bit more, just on a personal level, before we actually start getting deep into the weeds. You're a licensed pilot, right?
The technical term, I'm a certificated pilot. I'm a private pilot with an instrument rating. It was my COVID activity. I'm not that great of a golfer, so this was the next best thing for me to do. So I think about 4 years now, I've been flying small single engine Pipers and Cessnas out of Republican Islip Airport here in Long Island.
Wow. So you needed a getaway vehicle in case COVID got out of hand. Got even more out of hand.
That's right. I had a lot of convincing. I had to convince the wife a lot to allow me to do that. We had to make sure our insurance policies were up to snuff. I will tell you the novelty factor has worn off with the kids. They don't care anymore. It's not cool.
Okay.
But it's cool for me, and I'm glad you brought it up because there probably won't be a conversation where I don't try to interject that I'm a pilot in any conversation.
Got it. How many people can you fly with?
So they're small. Think of a Honda Civic with wings. They're not luxurious, fast, large planes, but you could fit maybe 4 adults with 3/4 of fuel. You're not going to go anywhere fast or high, but it is a great hobby to go around Manhattan. I've flown to Atlantic City, Pennsylvania, Connecticut, Block Island. It's a nice treat.
So how do you define fast? I'm assuming, I have no idea, but I'm assuming there's a difference between fast in a car and fast in a plane. I'm assuming fast in a plane is faster.
We go by knots, and a knot's probably about 1.15 to a mile per hour. So, maybe 115, 120, 130 miles an hour over the ground, maybe, depending on the wind. So if you think about that, your commercial airliners are, 4 or 5 times as fast. So depending on traffic and weather, a car may get you somewhere faster. But interestingly enough, living on Long Island Sound is between Connecticut and Long Island. It'll take me 3 hours to get to a client in certain parts of Connecticut, taking about 35, 40 minutes to fly there. So it has been helpful professionally, but it really just depends.
Do you need to go? They don't do like a TSA when you fly a smaller plane, right?
No, they don't.
Okay.
The FAA could ramp check you, wanting to check your license and your paperwork, and it does happen from time to time. Certainly, if I flew into Canada and came back in, I'd have to go through customs, which happens if you're touring in Niagara Falls and things like that. But no, that is the benefit of general aviation. You could just drive up to the plane, put your bags on, and go where you need to go.
There you go. All right, should we dive in? What are we getting into today?
Lots of good stuff to talk about. How did you want to start us off?
So
why don't you give us a lay of the land? Where are we today in terms of the tax picture, and where might we be headed?
Sure. I will say this is a really, really exciting time for wealth advisors, attorneys, professional service providers, because not only are we in an election year, which is exciting just from a tax policy and planning perspective, because there's so much uncertainty around everyone's platforms, what's going to happen post-November. On top of that, we have some major sweeping tax legislation that has been enacted for a couple of years, the Tax Cuts and Jobs Act, which is set to expire in December of 2025. So we have some really important legislation. We have an election, and sometimes those don't jibe really, really well. So what I thought I'd go with is let's just talk about the environment where we're in today for folks that are doing some estate planning, insurance planning, wealth planning, and tax planning. What's the environment look like now? What's it going to look like next year? And then if nothing happens, what that looks like. And then we could pepper in the Republican platform, the Democratic platform, and see how that integrates in with any planning opportunities and action steps that we might want our clients to think about. That makes sense.
That's great. So you mentioned the Tax Cuts and Jobs Act. Just for our listeners, can you just briefly, in just a couple sentences, what is that and why should we care about it right now?
Yeah, no, that's a good question. So Tax Cuts and Jobs Act was around 2016, 2017, and it was some pretty groundbreaking tax legislation. It was probably one of the biggest dives in the tax code since the 86 code. And if you think about it, there's a couple of dates we think about when we talk about tax policy. And something that I learned doing research for this was we actually had some tax regulations on books as early as 1874. Codified in 1919, I think, and then 86 was the biggest reform bill that everyone sort of talks about. 2016, 2017, I think, was really, really important. It was interesting, though, that it got passed through the budget reconciliation process, and that was there because when you enact certain tax legislations, you need a certain number of votes to get it passed. In order to get lesser votes, if you make certain pieces temporary, so as to not go over a certain budgetary constraint, you can get certain things passed. So the corporate provisions of the Tax Cuts and Jobs Act, primarily reducing your corporate rate from 35% to 21%, was huge, right? But the individual provisions were made temporary. Some of the major ones were reduction of the highest marginal rate, right, 39.6 to 37%. we had this 199A deduction, or qualified business income deduction, which gave flow-through entities, small business taxpayers, this additional 20% deduction. And that was done to really equalize a 21% corporate rate and a marginal rate for individuals of 37%. So it actually brought down that 37% rate to 29.6% to equalize that. It did away with the SALT cap, which we know is a state and local tax deduction. For folks living in blue states, which tend to be your West Coast states, California, New York, New Jersey, Connecticut, Pennsylvania, where your real estate taxes are high, people saw huge cuts in their ability to deduct real estate taxes. But on the flip side, their applicability to the alternative minimum tax, AMT tax, went down. So the Tax Cuts and Jobs Act, oversimplifying it, reduced the corporate rate, reduced the individual rates, increased the standard deduction by 2 times for a lot of taxpayers. So a lot of taxpayers saw their taxes go down while at the same time eliminating certain deductions. But it really affected certain geographic areas differently, depending on what subsidies were in those environments, meaning are mortgage interest rates higher in certain areas or real estate taxes higher in certain areas? Because a lot of those deductions, one of the biggest ones which was affected was mortgage interest as well, right? It used to be $1 million plus $100,000 of home equity indebtedness. Now it's $750,000, right? So that's sort of what the Tax Cuts and Jobs Act was, and we're still in that regime right now. Because of the reconciliation process I briefly mentioned, those individual provisions are set to expire at midnight on December 31st, 2025.
So that's the only reason they couldn't make it permanent back in 2016, is because
Correct.
of those budgetary provisions.
Yeah, and forgive me, I'm not. I think Lynn did a session not so long ago where she talked a little bit more in detail about the reconciliation process. But reconciliation process requires a smaller number of votes. In order to do that, though, you have to sort of target a dollar amount that it's not going to add to the deficit. Which, interestingly enough, and we could talk about it later, this is why you'll never see an economist running for president, because taxation is all politics, right? It's all politics, right? Everything we see in the code is legislation. It's either pushed from lobby groups, from constituency groups. A lot of times, tax policy is not driven and written and pushed by economists or statisticians.
Right.
And we could talk about what subsidies does to prices and tax policies and things like that. But to answer your question, Adam, it was through the reason they're temporary is to get through that process. So I thought maybe we just talk about what that looks like today. And so we have a couple slides to look at. So this is the environment we're in right now. We obviously just got through 2023. Those returns are due in October for those that are on extension. But when we're filing our 2024 returns in 2025, we still have those rates. Top rate is 37%, right? You could see that the level that gets you there goes from 693 up to 731. Estates and trusts have always got to the highest marginal rate really, really quick. We have some business loss limits for those that have excess losses from businesses that they materially participate in. Again, here's what the deductions look like, and these are all as enacted in Tax Cuts and Jobs Act. We have our standard deduction, which is very, relatively high for married taxpayers. Obviously, you're talking to your clients about using 401ks, IRAs, things like that, HSAs. These are what the limitations are right now. Interestingly enough, and we'll maybe touch on it a little bit later, what our lifetime estate tax exemption, Tax Cuts and Jobs Act, almost doubled it for a lot of taxpayers. So there's a lot of opportunity before sunset to do some estate planning, or at least talk to our clients about looking at it. What does your personal financial statement look like? What's your balance sheet look like? What are your goals for your legacy, right? How do we plan for those types of, asset transfers?
This is pretty big right now for us from a financial planning perspective. I know we had, in a prior episode, we had Mike Townsend on, who is a political analyst down in DC for Schwab. And he was talking a lot about this. We're starting to hear more of hey, if you're in that 10 to 15 million plus range, you should start thinking about reviewing your estate plan today, not even though the sunset may or may not occur at the end of 2025, as you've got here on the screen. Attorneys are going to get capped on their ability to revise estate planning docs pretty quickly.
Yeah, no, that's a good point. And you touched upon two really important things. One, the wealth level and the timing. We're here right now. I know it might be hard to see on my screen, but we're right here. Right here we are in August, right? This is when the sunset happens. Attorneys are going to be very hard pressed doing any type of planning in these couple of months, right? Where they have to draft documents. So we only have about 8 months, 10 months maybe, to really have these conversations. And I will say, you could draft the documents and fund them later, right? But no attorney is going to be happy doing this planning at the last minute. If anything, I could see clients waiting post-election post-November to see what's happening. But really now is the time to have that conversation with you guys, with other advisors, to really put into place any type of planning, or at least have that conversation, right?
The marginal cost of getting it done, having the documents in place and drafted even prior to the election, I feel like is going to be a benefit, regardless of what happens with the election. Getting in with a firm to draft these documents ahead of the election, because I can only imagine, depending on the election, there may or may not be a huge rush of people at that point too, right? So having your ducks in a row even before the election could benefit you.
Look, if you're spending a couple $1,000s, and I don't want to spend anybody's money, it's easy for me to say this, but if you're a high net worth individual and you have a sizable balance sheet and you're spending $5,000 to $10,000 on some planning that ends up, let's say the sunset doesn't happen and gets extended for a brief period of time. Well, what you've done is you've still looked at your overall estate plan, right? You've done a disaster scenario to see if it meets your goals, to see what the dispositive provisions of your will. I always tell clients every 5 to 10 years, you should revisit these documents, right? We tell our clients to revisit their wealth planning strategies. We're looking at their insurance. We're looking at their tax plan in real time. So it might be a sunk cost for some, but if anything, there's value in the exercise.
Yeah.
So what's the difference here? So we're talking about if the Tax Cuts and Jobs Act expires, what are we looking at?
Yeah. Thank you for that layup. If let's just talk about individual rates, because that's what most people are talking about. What's going to happen to my taxes, right? And without talking about SALT cap, other deductions, brackets, rates, credits, things like that, all that makes the calculus a bit more complicated. Let's just very simplistically, let's talk about individual rates, right? We've benefited from low rates. 37% is the highest marginal rate, right? With the expiration in 2026, that first tax year, look what happens to everyone's taxes. 37% to 39.6, and you get there a lot faster.
Right.
And so again, I don't want to talk political motivations around this right now. That's not the purpose of this forum here. But notwithstanding any type of legislative push, extension, modification, amendments, the way the law is written right now, on January 1st, 2026, taxes go up, right? And if you just, for example, look at 2025 to 2026, right? The 24 bracket goes to 28%. And you go while in the prior year, someone could have been in the 24% bracket all the way up to almost $400,000. Someone's going to be in the 33% bracket at $300,000.
Right.
That's huge.
That is a big increase. But how do these rates compare to rates historically?
Well, interesting enough, if you look post-war, right, World War II, some rates got as high as 80, 90% on some levels of income, right? 50% marginal rates weren't unheard of. So, in the grand scheme of things, these are still sort of relatively low historically. But these are primarily high rates. If you live in California, New York, where you could have marginal rates, state and local, of almost 14%, you tap on 40% rate, you tack on 14% state and local rate. You add on the piece limitation, which we could talk about, which is the phase out of certain itemized deductions, which could add another 1.3% to 3% of marginal rate. You could have tax rates for certain taxpayers 55%. It's huge, right?
That's a huge chunk. That's, more than half of every dollar coming in, right?
Yes. And again, you could talk about, well, what that does to social programs and things like that. Let's put that aside for a moment. The marginal rate's going up, and the effective rate goes up as well with some of the disallowance. And so it's not just the rates, though. This is where we are right now, right? This is sort of Tax Cuts and Jobs Act. We have our 7 brackets. We're still going to have our 7 brackets, but we saw how the brackets changed in that previous slide, right? Again, just 37 goes to 39, 35, we still have the 35, 32 jumps up to 33, 24 to 28, and we still keep these 3 low rates, although the top one of that third bracket goes up a little bit, but we still keep the 15 and 10%. But most of our clients are not really in this realm here. They're sitting up here, right? Everybody knows the exemptions went away with the Tax Cuts and Jobs Act because standard deduction was doubled prior to law, right? So post-sunset, standard deduction gets cut in half again, but we have our itemized deductions back again, meaning the SALT cap is lifted. You get those business deductions that are subject to 2% limitations. More and more people are going to itemize their deductions. We have a 60% limitation for charitable contributions now. It goes to 50, which, I don't want people to donate to charity that's tax motivated. However, it's that 10% cut will definitely impact a lot of taxpayers' ability to donate, especially your high net worth taxpayers. So it is going to change behavior, right? The big one is, I don't have a slide for it, but the SALT cap goes away, the state and local tax deduction, right? $10,000 now. I know for me, I live on Long Island. Previously, state and local taxes and real estate taxes was my biggest deduction. Right? Taxes are very, very high in Long Island. New York State taxes are relatively high compared to the rest of the union. So that was a big deduction, but you also found taxpayers that received those benefits were also in the alternative minimum tax, right? Because alternative minimum tax is a parallel tax system. It adds back certain deductions that you would take on your regular tax return. They disallow it for AMT purposes and then recalculates based on a 26 to 28% rate.
So the Tax Cuts and Jobs Act phasing out almost seems more of a headache for the IRS, right? Am I misinterpreting that? Because you get more people itemizing deductions, you get the AMT back. Does that put the IRS under just mounds of more work?
Yeah,
well, it's a good thing they hired 87,000 more people a couple years ago.
Right. That's where I was going. They've been on a hiring binge. It is going to put a lot of stress. There's a lot of things in the code that are just being litigated in the courts right now. You see, you have qualified opportunity zones. You see qualified small business stock, which, these things have been, qualified small business stock has been around for a long, long time,
right.
But it's only been a few years, which the benefit of 100% exclusion on gain for certain taxpayers, it takes a while for the IRS and the courts to catch up. It does create a lot of opportunity for abuse and for creative use of the system, which has never been something that's been unfamiliar with the tax code. If there are ways to make it easier, you would make some of the ambiguity, you would take away a lot of the ambiguity of the code and make a lot of the provisions. You'd want to have activity and behavior and tax character to be much more aligned, right? Which you see a lot of abuse. But to your point, Austin, yeah, I think this is going to put a lot of headaches initially. I would say a lot of taxpayers' returns were easier to prepare in 2017 and 2018 through now, because again, most people take the standard deduction, right? Your taxes were limited to $10,000. You were going to do your normal charitable contributions and all your business deductions, right? People say, can I write this off? Can I write this off? Those were disallowed. And they're back, and they will be back in 2026. But having more of those deductions more and more taxpayers will be subjected to the AMT. And I won't touch upon those couple slides, but here's just a quick summary of some of those deductions that'll be back in 2026. Again, SALT was limited to 10 grand. There's no limit now, but we see the negative ramifications from that.
Investment management fees, that's relevant to our business and to our clients. I believe those used to be deductible if they were paid from taxable accounts, right? So many clients used to have their taxable investments, the fees from, say, an IRA or something deducted out of their taxable account. Is that coming back as well? Would that be part of this if the TCJA sunsets?
Yeah, we'll have that. That was a huge thing from some of our clients years ago. What am I doing with these expenses? And there were a lot of structural conversations of, do I want to set up a family office, right? You had lender management, which was a big case for family offices on how to deduct these types of expenses, management fee expenses, and investment management fees, investment interest, things like that. Very big case. It was actually the family that owned Lender's Bagels, believe it or not. But I think there's going to be a lot more simplicity for certain things, especially for clients that have traditional portfolio accounts. We'll have those expenses, but a lot more complexity in some of the other things, as you can see here. Again, you have mortgage interest is going to be a little more robust. You have home equity loan interest being deductible again as well. Again, the SALT's going to be huge. You have the job and miscellaneous expenses, which are going to be deductible again. Prior to this, they were subject to 2% floor. They'll be subject to 2% floor again, which will throw people into AMT again. So it's going to, it took, I think, tax practitioners a year or two to get their handle on the Tax Cuts and Jobs Act. It's going to be us learning a new tax system again that we haven't been involved in for a while. So it keeps us employed. It keeps us engaged. I don't know if a lot of that relearning time is going to be billable to the client, but it is a great opportunity to have these conversations now and plan around this. And again,
that's so interesting. Usually you want to spend time learning a new skill. Instead, you're going to be learning how you used to do things 7 years ago.
Absolutely. When Tax Cuts and Jobs Act came out, we were telling our younger staff, everyone has an opportunity to be an expert in something that no one else in the country is. It was brand new, right? Nobody knew what the impact of 199A, the qualified small business deduction, did for taxpayers. No one knew the dynamic of just restructuring your business. There might be now a push for clients to be a C corporation as opposed to a flow-through entity, right? Even with the rates going up, there was a push to be a flow-through entity to get that 29.6%. But maybe now it makes sense if the corporate provisions are staying permanent. Maybe I want to be a corporation at 21%, get my dividends, and my effective rate might be lower as a corporation than I would be as a flow-through entity. So a lot of the planning that we've done for years might just get canceled out and re-envisioned with the potential new laws. And remember, that's just the law that's on the books right now. That's not talking about any proposals from any of the candidates coming out of the Republican or Democratic Party, which, if anyone's watching the news, that's all anyone's talking about. So we don't really know what's happening.
So let's dive into that. We have, Kamala Harris and Donald Trump. What do those, let's start with Trump. Maybe that's the easier answer here. The TCJA was his policy. He probably wants to keep that in place, right? And
that's right.
Are there changes beyond that? Or if he wins and there's a Republican sweep, as of today, it's simple enough to just say things will probably stay how they are.
Status quo.
Yeah. I will say the only thing that's certain is uncertainty, right? I will say that was his sweeping legislation. I suspect he's said in the past that he wants to make the individual provisions permanent, right? But Tax Foundation, a lot of policy centers have quantified, and I don't have that data, it would be disastrous to what that does to the deficit, making some of those provisions permanent. But he's been firm in saying that he would like to extend these provisions and make them permanent. And if anything, he'd want to continue to lower taxes, probably on corporate payers, and lower taxes on individual taxpayers. I will say, in general, the political theory is Republicans generally wanted to get rid of the SALT cap because it benefits the wealthiest taxpayers in the blue states, which tend to be your coastal states, right? So that's always been a Republican idea, just based on political game theory, is let's eliminate the deductions for those constituents that are the biggest donors to the Democratic Party. I haven't been through the Green Book in great detail, which was President Biden's plan, but we know from Vice President Harris in the past, when she was campaigning in 2020, she at the time aligned herself very much so with Biden's policy, which have called for higher taxes on the wealthiest of Americans and corporate taxpayers. So I would be remiss to say that the Democratic platform generally would call for an elimination of a lot of the Tax Cuts and Jobs Act provisions. I know from what I've read, there are a lot of additional credits for smaller taxpayers, for small businesses, for families that need a little bit more assistance. In terms of rates, they've called for increased rates on folks that are at the top of that 39.6 bracket, adding another 1 to 2% increase. Elimination of certain deductions for certain taxpayers that have certain wealth levels. There's always been a conversation on what are we really taxing? Are we taxing income? Are we taxing assets? Are we taxing wealth? Right? That's been a debate in the media for years, right? And it's a philosophical one at best, but the economics of how a progressive tax system works is something that I don't think any country has ever really figured out in a perfect form. So I suspect a Trump platform would extend the Tax Cuts and Jobs Act, and a Democratic platform would let a lot of these provisions expire, and or potential changes and amendments to the corporate provisions. In my estimation.
Is there any historical precedent to taxing unrealized gains?
It's been something that's been talked about for a long, long time. I don't have a lot of the academic theory, but there's been papers and commissions that have wanted to tax that as income. Because if you think about it, right, and I don't want to open up a can of worms here. If I'm an ultra high net worth taxpayer and I have a concentrated stock position, right? Let's say I have a pre-IPO company and I got hundreds of millions of dollars of stock sitting at a major institution.
Right.
Well, guess what? I could leverage against that. Right? I could get cash to go out and buy assets with that money.
You never have to sell.
And never have to sell.
Right.
So me as a taxpayer, as a regular taxpayer, I can't do that. I have to use my net after tax proceeds to go buy an asset, right? So if it's not income, but I could use it to accrete my wealth, well, why shouldn't that be taxed as income? Because it's creating wealth, right? On the flip side, if I can't use it, I can't use it, right? And so there's been a conversation about, do you tax unrealized gains? But then you have the question is, okay, well, how do you index that to inflation, right? If I inherited a stock in the 60s or bought a stock in the 60s or 70s, right, you should definitely adjust my basis, right? You should
that's
index
the big
my
thing
basis
for me.
currently,
Yeah.
right? They talk about basis indexing for years. The point of the capital gains system was to spur investment, right? Let's encourage taxpayers to invest in capital-intensive businesses, spur business growth, job growth. But we all know folks could game the system, right? If I'm If I'm a wealth manager for an institution and my income is structured as wage, I'm paying a marginal rate. If I'm an investment manager for a fund and it's structured as a carried interest, well, I'm paying capital gains rates. I'm doing the same job, potentially. Right. So there's a lot of gamesmanship with the code. So to your question, is there a lot of precedent? There's a lot of discussion around it, and I just don't know how you would implement it effectively.
Yeah, it seems crazy to me. It almost seems capitalism, right? Also, what happens when you get taxed on your unrealized gain and then your unrealized gain goes away because, the position went down, right? You're going to give that money back? That's
right. That's right.
If they if they raise the basis along with whatever taxes you pay, then you could turn around the next year if the value of that stock take a loss if it drops significantly.
I think it makes a lot more sense for basis indexing than a tax on unrealized, because at least you could quantify the basis indexing. It only makes sense if I bought a stock. If I inherited a stock from the 30s or 40s or 50s and I sell it today, my purchasing power has been inherently adjusted because it's just not, the cost of that isn't what it is today, right? The same dollar is not the same dollar.
Right.
I think that makes a lot more sense. I would love to see an academic paper on how you effectively implement taxing an unrealized position. But I do find it interesting that certain taxpayers with certain banking relationships can use that unrealized appreciation to sort of access liquidity when other taxpayers aren't afforded that same benefit with other assets, right?
Right.
If it's not income, right? Because to your point, I could use it to buy and sell assets and never have to return that money.
I feel like the I'm just going to call it a wealth tax, right? Air quotes for those listening. I feel like that's one of those things that every couple of years, this worry pops up as if like it's going to cause this great stock market sell off or something, because everyone's going to sell all their assets before this tax goes into effect. It's the most ridiculous argument, and it comes up from time to time. But
I don't think that's true. I think, look, the estate tax impacts a very, very small percentage of the country, a minuscule percentage. Yet, the East Coast and West Coast taxpayers, which tends to be your ultra high net worth individuals, aren't representative of the voting bloc in America, right? So it's a really good policy piece and a soapbox platform. But the reality is these wealth taxes and the estate tax, in terms of a percentage of the population, it doesn't impact a lot of people. But it's great. It's great news. It's great. Yeah. It's a great conversation piece.
What about the percentage of the budget or the tax revenue? I'm assuming it represents a larger share of that, or no?
It does. But if we go back to the let's say the Tax Cuts and Jobs Act, if it's made permanent, it would add trillions, I believe, to the deficit over time, right? And again, where's that tax revenue going from a wealth tax, right? So it's really a short-term solution, I think, right? Because it's not I don't believe a wealth tax would be a progressive system, overall. And then how do you ensure that those funds are really used for, the public welfare and the public good? So I'm not so certain what that really does in the long term and what that really adds to reducing the national deficit and adding to other programs that Americans need.
Right. I guess it's a damned if you do, damned if you don't type situation too, because no matter what the rule is, anything that will be able to pass, there's going to be a loophole that we're going to be able to figure out.
I don't think any industrialized country that has a progressive tax system out there has figured out a way to fund social programs efficiently and effectively through using the tax system. I don't know. I don't. Maybe I'm wrong. I can't think of any. So it's certainly an interesting thing for the politicians and the economists and the philosophers to discuss over a scotch.
I'd be curious to hear if someone like Nancy Pelosi, with all her success in the stock market, how she feels about unrealized gains being taxed. There's like algorithms these days that copy trade these politicians. It's insane.
Yeah, and if you look at the timing, they're almost as good as the quants, right? And the quant funds. Right. But yeah, look,
it's almost as if they know something.
It's almost, look, it only makes logical sense if you're sitting on a finance committee. If you're sitting and you're talking about legislative change and policy change, you have that information. I mean, there definitely needs to be some regulations on, whether all your assets are in a blind trust. You can't trade. You have to wait 30 days, 60 days, 90 days for any trades, or needs to get approved. But it's always been nonsense to me that there are certain folks in our government that play by different rules than others.
Right.
Everyone should be on an equal footing in an equal playing field, especially those that are writing the laws.
Right.
They should be right there in the trenches with all of us.
Right. Does the president's money need to be in a blind trust?
Yes, I think
right?
so. Yeah. I think
so the president's money needs to be in the blind trust, but the people actually writing these laws doesn't, which is interesting.
Yeah.
When you put it that way, yes, that's very odd.
Even in health insurance, right? They get to use different health insurance. And someone said to me that's kind of interesting. If they can't pass the budget, or a balanced budget, then all members of Congress shouldn't get paid, right?
Right.
Yeah.
But, that would never jibe.
Right. It's like it's your job, right? I don't get paid if I don't do a good job at my job. You don't get paid if you don't do a good. What?
Politics and professional sports.
That's it.
Also, like CEOs can't just trade willy-nilly of their own stock, right? They're an insider. Other C-level executives, other people.
You actually have to.
Like they're the ones writing the laws. They're literally bending the rules as they're trading in these companies that get affected by the rules. It's not to make a political statement or anything.
No, you're entirely right. If you're a CEO, you have to disclose with the SEC what your trading plan is over the next couple of months. Right. You have to let them know the date, the shares. It would be interesting to think if it would make sense for our politicians to do the same thing.
Right. So back to the TCJA. What should clients be thinking about right now?
Yeah, good question. So I think irrespective of wealth level, I think clients should be thinking about their short-term and long-term goals, right? Both from a liquidity perspective, what do I need in the short term, midterm, long term, what major expenses are coming up, college, weddings, bar mitzvahs, vacations, and then look at their overall estate plan. I think now is a really good time to have conversations with their board of advisors. And what I mean by board of advisors are their wealth managers, their insurance professionals, their estate planning attorneys, their CPAs. Because it's so nuanced and there's so many factors that are in play right now between a November vote and an expiration or a sunset of these provisions, I at least want to make my clients aware of what the environment is, right? We don't have to make decisions. I want my clients to be educated enough to make those decisions with me and with their advisors, because again, we may need to suggest redeploying their assets in a different type of allocation methodology, right? We may, if depending on where rates go, if it affects, fixed income or something like that. We may need to look at some older trust documents that were drafted a couple of years ago that might need to get updated. We may need to think about how we utilize a client's lifetime exemption now before the sunset in 2025. If you think about it, and I think, Adam, you mentioned, what do you do with your clients that are $10, $15 million? If I'm worth $15 million, guess what? I don't have a federal taxable estate right now, right? If I'm married. But guess what? In January 2026, I sure am going to. Mm-hmm. Even though it doesn't seem like that, right? And I hate to sound disingenuous, but in today's world and sort of New York City, $10 million wouldn't be considered a high net worth taxpayer as opposed to someone that might live in the West Coast, in sort of the middle of America, right? So
yeah, I mean, real estate values are up, stock market's up, business valuations are up from even 4 or 5 years ago, right? So, what was $1 million a couple years ago is, maybe 1.5, 2. These numbers double quickly. And
correct.
That's not even talking about what the next couple of years could bring or the next decade or beyond. And if for people who are business owners still in a wealth accumulation phase before they begin to draw down on their estate over time,
you're right.
You have to also project where you're going, not just where you're going to be this year and next year before the sunset. No,
you said it perfectly. And, part of that, trying to talk to a client that's worth $10, $15 million, that's going to be impacted by the sunset. And now you're asking them to irrevocably transfer $3 to $5 million. Well, that's real dollars. That's real liquidity for these clients. And now their decision making might be impacted by this. So
now let me just make sure that the listeners understand what you're saying. You're saying use up the exemption now, right, while it's higher, so that if the exemption comes down, you're already used up and the government's not going to take that back, right?
Correct. Right. Okay. So we know that there's not going to be any clawback of exemption. So I'm just going to use round numbers. So let's say we have $30 million of exemption right now. A taxpayer could irrevocably transfer out of his estate $30 million. And so now his taxable estate goes from $30 million to zero. Or, maybe he keeps some cash, marketable securities, jewelry, real estate, art, things like that. But now all those assets that are transferred out of his estate, the appreciation is out of their estate and will transfer to the beneficiaries based on the dispositive provisions of the agreement. Now we're going to potentially go to 12 or 13 million, right? And so if it's 13,
as the exclusion,
what happens to that 17 million? IRS isn't going to come after that. But if I wait to do any transfers until January of 2025, I only have 12 or 13 million to transfer.
Right.
So now if I'm worth 30, I now have a taxable estate. Right. So part of this conversation can't be done in a vacuum, right? CPAs can't be the only ones doing it because we need to discuss this with the wealth advisors, right? What's the client's burn rate, right? What's their cash flow like? What's the Monte Carlo analysis of how much money do you have at 80 years old, 90 years old? People are living much, much later. So I may not want to put all this money away in a trust that I don't have access to. Now, again, there are certain types of trusts that exist that allow for spouses to access the assets that are in a trust. But for the most part, when we're talking about gifting, we give up control of those assets. It's not my money anymore. And so we need to talk about what that does. And then how does insurance come into play, right? Do I need an insurance product now to fill in the gap of my net worth, my taxable estate, to what the exemption is? Does now insurance go from a diversification tool to an asset protection tool? Obviously, we know insurance is always used to shift risk. But now I may need an insurance policy to create liquidity to cover a tax bill.
Yeah. Right. So when you die, the insurance policy kicks in, which gives who's ever left, right, the cash to pay the tax bill.
Correct.
Right.
So I know I beat the horse to death already, but now August is the time to have these conversations with our clients, with our advisors. The strategies are going to be need to be worked out in a team environment.
Right. I like that you bring up the team, the multiple advisors and the goals, because the goal isn't always to save money on taxes. Sometimes saving money on taxes hurts, your other goal over here. Right. And then also from, the team aspect, people have different relationships with their accountants than they do with their wealth advisor or the insurance agent or the lawyer. Right. So, to be able to get that well-rounded coaching, I think makes a lot of sense. I've been in situations where the client comes to me and he says, the CPA says to do X, Y, and Z. And I'm like, well, wait a second. It doesn't quite fit your risk tolerance. Two, I thought we talked about, doing this, and that seems counter to this, right? And to the tax person's credit, right? They didn't know that. They didn't have the conversation. They didn't have that experience with the client, but the wealth advisor did. And so it's really important to get all the views at the table, right? Us thinking, the wealth advisor thinking from the your end goals, financial projections, things like that, and then the tax person, professional, thinking about, well, how do we save the money? Because they do conflict sometimes, but there is a middle ground where it works and it's productive.
If you're doing tax and estate planning without confirming that the financial planning aspect of this still holds true and you can successfully retire and save enough money for the lifestyle you want to live, if you're doing the first part without the second part, there's an error taking place there.
Yeah, I think that's a very negligent activity. I use this term a lot. I'm known to use cliches, but I consider myself part of a client's board of advisors with the wealth advisor, with their attorneys, with their insurance professionals. We are one team. And I think, Austin, you said it right. A lot of times an estate planning strategy might be tax inefficient, or a tax strategy may not be what the wealth advisor wants for the long-term growth of the portfolio, right? So we have to find some middle ground. And to Adam, to your point, I don't do any planning unless a wealth advisor is at the table. I am not an investment professional. I know enough to be dangerous. I'm knowledgeable about the market, but you guys are the experts, right? And working with the ultra high net worth population, you have to have that seat at the table. And frankly, to some extent, I would even say the wealth advisor might be the most important person at the table, because that's the one that's the keeper of the keys of all the assets, right? Because if I'm developing an estate plan with the attorney, I need to target the type of assets that we're using. Whether is it private equity? Is it a hard to value asset? Is it art? Is it fixed income? Is it other marketable securities and cash? Now, if I'm pulling a basket of assets, well, guess what? The wealth advisor needs to now fill in the gap. If a client is yielding $2 million of cash on his taxable portfolio, and I'm taking some of those assets that generate that yield and sticking it into a trust that he can't touch, well, guess what? How do you
there
fill
might be
that
a shortfall, right?
Right.
Or maybe not, but with proper planning, you can figure that out. You can understand what can someone irrevocably give away and still be able to comfortably live their life based on what they're earning.
Which is why it's a team approach, right?
Yeah. Oh, 100%. Yeah. Let me jump in and kind of flip the script here. We've talked about what is coming in a couple of years, and there's a lot. The only certainty is uncertainty, right? We don't exactly know what the future holds. What can you say about taxes longer term, 10, 15, 20 years down the road? I mean, you talked about the deficit already. I hear a lot and often that taxes have to be higher in the future, no matter what changes in the short term. Is there validity to that? Can you talk to us a little bit about what you think the longer term outlook for tax rates in this country might be?
You're really ending with a hard question.
Oh no, I've got a better one next.
And this is my sort of personal view. I think without any type of sweeping social reforms in how we live our lives and the expectations we have from our government, the world is getting more and more complex, right? Business is getting more and more complicated. The needs of Americans are getting a bit more robust. And I'm a firm believer that we need certain social programs in this country. They need to be funded somehow. We live in a wonderful country that affords us beautiful freedoms that a lot of countries don't have. Look, some of our Scandinavian countries have tax rates higher than 50%, 60%, yet they're the happiest countries on the face of the earth. So I don't want to get into the socialization aspect of things, but government serves a purpose to protect and provide for your population. With that being said, I think taxes only get more and more complicated.
Right.
There's still nuance in the code that hasn't been looked at for over 50, 60 years. It's ripe for manipulation. If you have the resources to do these complicated, esoteric strategies for tax mitigation purposes, then you can do that. You need to hire attorneys and accountants to look through the code and pick out nuanced provisions that really limit regular taxpayers the sophistication that sophisticated taxpayers are allowed to have.
Right.
So I don't see it getting easier. I think I see it getting a little bit more difficult.
Right.
And I see taxes going up over and over time because it's just getting more and more expensive to live. Just think about it this way. And again, I don't want to talk politics, but when you subsidize a behavior, you're inherently inflating the price of that asset, right? And why do I mention that? Well, the code inherently benefits those that purchase homes and incur debt, right? Mm-hmm. You get to deduct your real estate taxes, you get to deduct your mortgage interest. But if I'm a renter, why should I not get some benefit as well if I think it makes more economic sense to rent? So the tax code is incentivizing the behavior, and we all know when these types of incentives artificially inflate the price of the asset. So maybe allowing a deduction for home mortgage interest and real estate taxes are unfairly increasing the prices of real estate across the board, making it unattainable for certain taxpayers, sort of exacerbating that cycle. Again, I don't know. It's certainly just
possible.
a thought.
Right.
Right?
Yeah.
So yeah, certainly possible. So yeah, I don't see things getting easier. I think things are getting a bit more complicated. Look, whenever there's new legislation, it keeps me employed. It's time for me to research and learn and implement it for my client. Now, a lot of the things that we have to do as practitioners add very little value to the client, just for them to stay in compliance with the law. I mean, it doesn't put more money in their pocket. It doesn't help them accelerate income to a lower tax period, defer expenses to a higher tax period. It's just, hey, by the way, Mr. and Mrs. Taxpayer, you have to fill out these 3 forms because the government's asking you for them.
Right.
Well, I need to find a way to bill them for that, and then find a way to let them know that why it's important and why they need to pay for that. Yet it doesn't add anything to their bottom line. So I think things get a bit more complicated.
Not to belittle like your industry and your profession, but if we do all this work to file taxes and I cut a check to the government, they turn around and say, actually, no, you owe more, or here's your refund, you overpaid. At the end of the day, like, can't they just figure it out and tell me what I owe and then I'll pay that?
Right.
Like, why are they making me and you do all this work to guess and ultimately be told we overpaid or underpaid?
Well, you would think, look, I think one of the biggest lobby groups out there are those for at-home tax software preparation, right? There's been programs in place for years where the government gives you your tax return. Most of our stuff is already reported in the system.
Right.
They know what we make, they know our taxes, and if you have some adjustments, but we know tax policy is pushed forward by lobby groups, constituency groups, professional organizations that say, no, taxpayers are not that sophisticated. To that end, though, there are taxpayers in other industries where their tax and financial picture is not bread and butter, right?
I'm sure there's some level of trust that is required as well. And, if the government tells you owe a certain amount, you might pause and scratch your head for a minute and say, is that really what I owe? Let me do the math here.
I had someone reach out to me the other day that was certain the 16th Amendment wasn't ratified and that the Internal Revenue Code was illegal. And he asked me if I would amend all his returns to get back all his federal withholdings. I'm not joking. This was a conversation I had with a business owner. I don't know how he found me, but I gave him the time of day. And he's like, Internal Revenue Code, this is legal. You can't charge income taxes.
Oh, boy.
Okay. You have at it. But
did you try and call the phone number back? Did it ring out to some payphone in India?
No, I did it over. We were looking back and forth. It was over Teams. But it's interesting. Look, I think the IRS could do things to make things a lot easier for a lot of taxpayers.
Well, that was my final buzzworthy question was, look, if you had a magic wand today and you could swipe it over, the tax forms of our country, what would you change and why?
Wow, that's a great question. I think I touched on it before. I think there's a lot of ambiguity in the code, right? I think two practitioners could look at a court case opinion. Look, there's the code, right? Then there's the regulations, and then there's the tax law, the tax cases, and all of these things sort of meld with one another. There are some provisions of the code that are really just one paragraph, yet there's pages of regulations, and then there's dozens of tax court cases open to interpretation, right? And so if I had that magic wand for a day, I would say take a deeper dive of the code, update it, refresh it, and take away the distinctions between character of income and the activity of the taxpayer and put everyone on an even playing field, I think. It is complicated. We live in a complicated world. The political system's complicated. But understanding that, once you understand that all the deductions and credits and expenses that were afforded to deduct are not a result of potentially good tax policy, right, but because good legislation and good bill writers and a lot of the things in the code are snuck in there on a farm bill, right? Or some other type of legislation that, there's a couple pages of tax law in there. To me, that doesn't make any sense.
Right.
And I think we really need to fix that, because I think there's opportunity to make things a bit more fair for a lot of our lower income taxpayers that aren't afforded the benefits that we all have and have the resources that we all have. It shouldn't be harder for them to stay compliant, and their effective rates should not be higher than those with substantial means, if we want to talk about everyone on an equal playing field.
Awesome. This has been great. Did you have fun? Was this?
I did.
Did we explain everything we wanted to?
Yes. I thought we were going to talk more about flying and aviation, but I'll take it.
So
this was great.
What's new in Jonah's world? Is it did we steal it with the flying conversation?
You did. I'm waiting for my kids to come home from camp and getting them to put their iPads away and try to get reading time on the books again. And it's going to be very difficult.
When you were going to flight school, I guess that's what you call it, did they do the shirt cutting thing? I've seen that where, once you get to a certain point, they cut the back of your shirt. Was that part of the process?
Yeah. So the answer is yes, but for whatever reason, my flight instructor did not cut my shirt on my first solo. And do you know the history behind that?
So I do, but you should tell us. Yeah.
Yeah. So years ago, when flight instructors used to train their student pilots, they used to sit behind the pilot. And you see these planes like the Piper Cubs, the J3 Cubs, they're like the bi-wing planes or low-wing planes. Someone sits in the front, someone sits in the back. They didn't have radios. So the students wore like tail feathers on their coats or on their shirts. And so when the instructor needed the student pilot to do something, he would, tug on the tailcoats.
Right.
When the student proved that he or she was proficient enough to fly the plane on their own, they soloed, and then they cut the tail feathers because they were no longer a student. So now what flight schools will do is you'll wear like a white T-shirt or something to your solo, and then they'll cut it. For whatever reason, my instructor never did that for me, and I was still really upset about it.
COVID, yeah.
COVID.
There you go.
There you go. Just blame COVID.
Right.
Do you mind if I jump in, Austin, with
go for it. I was
what's
just going to ask you.
It's very frustrating, but nothing that any of us could control. It's Mother Nature's fault. Hurricane Debbie is rolling through New England this week and just causing widespread rain everywhere. I've been planning a camping trip up in northern Maine for this weekend for the last 2.5 months.
Where were you going to go?
We were going to go to Flagstaff Lake. It's in the northwestern corner of Maine, almost, equally distant from Vermont and Canada right there. And I was going to camp on the backside of Mount Bigelow, which I've hiked it as a kid. But, a couple of my neighbors, we've been talking about going and doing a day hike. And I said, why don't we go way up to northern Maine and we'll all get tents and everything like that, camp out for a weekend and turn it into a nice fun weekend. So I found this campsite on a lake right behind the mountain that we could hike. It was going to be, probably an 8-hour, 9-mile round trip ordeal on Saturday. And now we're just getting completely washed out. So we've been postponing actually getting together to plan our meals and prep and who's bringing what and what cars and who's packing everything. And it's not going to happen. It's such a shame.
You should consider Franconia Notch, New Hampshire in rotation. I used to love hiking up that area, and it's a shame because this would be a perfect time to hike.
Yeah, I've done Mount Lincoln's right there, right? It's one of the 4,000 footers.
Mount Adams, Mount Lincoln.
The presidential ranges right there in Franconia Notch. That's for anyone up in the New England area. That's loon.
Up tree line.
Yep.
And get in trouble.
No, it's that's a great area. It's beautiful up there. So for any clients or listeners, if you want some trip advice, reach out. I've got some great trips I can
unsolicited, of course.
So so I'm hopeful with all this rain that next week will be bright and sunny because I'm getting married next week and we have an outdoor ceremony. And
congratulations!
Thank you. Right now it looks like the weather's clear, but I'm hopeful that it's we're going through the rotation of the bad weather now, and we'll be into some better weather next week, especially
Fingers
on
crossed.
Friday. Yeah.
Fingers crossed. Oh my God, very exciting.
Yeah. So my what's new though is I feel like the three of us in our lines of work, we help clients with a lot of complex situations. A client comes to us and they say, this is my criteria, this is my issue, and we could find a needle in a haystack for them if we put our minds to it, right? So more recently, I've been trying to find a water bottle that is not plastic, holds at least 36 ounces of water or more. It doesn't leak, doesn't come with a straw, right? I want it to lock up safe. I want to be able to twist it upside down and is washer machine safe. Do you know how hard it is to find a water bottle with that criteria?
I feel like those are all pretty reasonable asks.
Right?
I should ask my 10-year-old daughter because she collects water bottles.
Oh my God. I could use any help that's possible. I actually went and I thought I found one. I ordered it. It's set on the website, machine washable, and it comes in and right on the box, right across the side of it says, wash by hand only. And I reached out to the company. I was like, what's going on here?
You should just ask ChatGPT to find you.
That's true too.
There you go.
That's true too. I'll put ChatGPT on.
When did water bottles become a thing? Like when I was a kid, I drank from a hose and a water fountain.
Right.
Now I have 60 water bottles in my house.
Right. Well, now we know about the germs. Yeah.
Right.
And my kids are like, I need my water bottle before I leave the house.
There was, when you were a kid, there was nothing more refreshing on a hot summer day than turning on the hose and just taking a sip out of it, right?
Right.
It's really, by the way, as my wife makes sure I have a glass water bottle. But
that's right. Yep.
It's really comical how many water bottles I have in the house. It's disgusting.
Well, you'll have to let me know. And if there's any listeners out there who've had the same issue as me and found a solution, please put it in the comments.
Please let us know.
That
put it in the comments.
You're going to wind up getting a delivery tomorrow.
So very cool. Very cool. So awesome. We appreciate having you on. To our listeners, we appreciate you guys listening in. Please remember to like, follow, and all that fun stuff. Share. We'd love to hear from you. It's been great. Thank you.
Thanks, Jonah.
Thank
Appreciate
you.
it.
Sure.